Hi, first things first, we hope that all of you, your families, and your coworkers are healthy and safe and adapting to this situation. We are operating as close to normal as we can and are here to help with any questions that you may have regarding your plans. We are going to cover the retirement plan impact of the recently signed CARES Act. Please be aware that there's still many details to work out, and we're staying on top of all of this as best we can. An immediate issue that needs to be addressed is how your plan will accommodate the CARES Act options. We're going to cover those details shortly. I also know that different record keepers are sending emails and requiring action in a very short window for you to respond. Our purpose is to help educate and explain how this affects your plan and to receive your direction on how to implement all these provisions. So let's get started. As you have no doubt heard, the Act is in response to the coronavirus and is a $2 trillion stimulus package. The features defined by CARES are optional to implement, so we have provided a form for you to communicate with us how these will be implemented in the plan. Please complete this and have it signed by an authorized plan representative and returned to us via email. We're going to use that to track how your plan will ultimately be amended, but you can start operating the plan with these terms in effect immediately. Together, we'll communicate to record keepers and employers what your plan offers. We're going to cover the events in the slides as we step forward here. A new withdrawal, coronavirus-related distribution, or CRD, has been defined. A CRD is exempt from the 10% early distribution excise tax that basically all other premature distributions are subject to. The usually required 20% withholding up front is also waived. Any CRD does not have to be recognized as taxable for the year in which it's taken. Instead, the tax can be paid ratably over a 3-year period. Further, it is also possible to recontribute any CRD back to the employer's plan or IRA, or even to another employer's plan if the employee is employed elsewhere within 3 years of the distribution date. In effect, this means it can be rolled over at a later date and beyond the usual 60-day window for rollovers. To be determined is how this works. If, for example, it was rolled over in year 3 and taxes have been paid on 2/3 of the transaction, I would believe that it would establish a cost basis in the plan or IRA that accepts it, but this is one area that we're looking for additional guidance on. CRDs have a $100,000 limit for any qualified individual. As an employer, what you are responsible for monitoring is to make sure that no one exceeds this limit from all of your company plans, including any other member of a control group that your company may be part of. Now, if you're a single employer plan with only one plan, it's very simple. If you sponsor 2 plans even, say a DB and a 401k, it's pretty easy. You just can't let someone take $100,000 from each or exceed $100,000 in CRDs from the combined plans. Ultimately, your plan has to be amended for these features, but not until 2022. Once you make the decision, the plan can be operated under those terms, as I mentioned. You will tell us your intent when you complete, sign, and return the form we provided via the email. As mentioned, you must be a qualified individual to take advantage of these rules. Here's the definition, and there are really 3 ways to qualify as such. First, the participants themselves were diagnosed with COVID-19 on an officially recognized test, or second, a spouse or dependent is also diagnosed. And finally, and most broadly, has suffered adverse financial consequences as described in the slide. This is where we think most, hopefully, because we don't want everybody to be sick, would qualify to take advantage of these provisions. What is your role in making the decision on who qualifies? The Act is very clear that you, as the employer or plan administrator, are not the party responsible for making that call. The participant can self-certify that they meet the criteria, and you can honor that request. More ambiguity exists here. Exactly what is being certified and what proof would the participant ultimately have to provide? That's not known at this time. And what really constitutes adverse financial consequences? Is it enough that hours were cut, or maybe that overtime is no longer available? That too is unknown. While there's no certainty in this, it would seem very difficult for anyone to deny that someone has suffered as a result of these events. The Act also permits the expansion of the amounts available for loans and also for leniency on loan repayments that are due according to the terms of the loan. Again, this applies to qualified individuals in the plan that has agreed to adopt these features. The maximum loan amounts are permitted to double under CARES from 50% of the vested account balance up to 100% of the vested account balance, provided that amount does not exceed $100,000. $100,000 is twice the previous hard dollar limit of $50,000. This increased loan window is available for 180 days after the signing of the Act on March 27, 2020. So this feature automatically expires September 23rd, 2020. It's only available for loans between that window, in that 180-day window. Further relief is granted for making loan repayments. If you are a qualified individual with an outstanding loan as of March 27, or who takes a new loan during that window of 180 days, then it is possible that those loan repayments can be delayed for 12 months. Interest will continue to accrue, and it seems likely that these loans will have to be re-amortized once payments do start or restart. So I can foresee the great need for coordination with the payroll and record keeping. The Act did remove the requirement that participants and beneficiaries must take RMDs in 2020, even for those 2019 RMDs that had a due date of 4/1/2020, or was the initial year that a participant had to take their first RMD. They don't have to take that one by April 1st, or in fact, the second one by 12/31 either. This RMD exception does not apply to defined benefit or cash balance plans, but only to DC plans. So if your participant has not taken their 2020 RMD yet, they no longer need to. If they took it within the past 60 days, they still have time to roll it over, even back into your plan should they choose to do so. Currently, the 60-day clock has expired for anything beyond that, and it cannot be rolled over. However, back in 2009, during the financial crisis, the 60-day clock was extended, and industry people are fighting for that again. It's expected to be go beyond that 60 days, but it hasn't been authorized at this point, so we can't advise you otherwise. This change is not really part of the plan. They've actually changed the law itself, so no employer action is required to make this take effect. Most of the provisions do pertain to defined contribution plans, but there are items that affect DB and cash balance plans as well. Any deposit that was due and not yet funded in 2020, either the 2019 contributions or for plans that are required to make quarterly deposits in 2020, generally larger plans, have been given the option to delay funding until 1/1/2021. In addition to that deposit, though, accrued interest will also need to be paid. This is a technical point, but when a plan's funded ratio falls below certain percentages, benefit restrictions are placed on distributions. For instance, when it drops below 80%, only 50% of a participant's benefit can be distributed as a lump sum. The other 50% is paid as annuity. Further, the Act allows for last year's funded status to continue to be used rather than updated as it normally would. This prevents the reduced funding percentage from being recognized now due to the market changes and affecting lump sum distributions. This Act is obviously a major piece of legislation and was passed in an incredibly short period of time. Many questions still exist. The IRS and DOL were granted broad authority to implement the Act, including the extension to filing deadlines for 5500 and other reporting, testing deadlines, distribution of notices, and other areas that they deem necessary. These are all actions that we're monitoring, and as we learn more, we'll share more. Please complete and sign the form that we provide telling us how you want to implement the Act. As I had mentioned, record keepers and participants are trying to figure out what they need to record keep, and some participants are trying to figure out what they're permitted to get. So we want to get everybody on the same page and help the plan run smoothly. We expect most people will add the features. So if you want the full features, just mark the first box in each section. If you want customization, when it's available, choose the second box. If not, choose the last box, and that feature will not be turned on. Please call or email us with any questions. We're continuing to serve, and everyone has the access to the tools that they need to help you oversee your plan. The previous slides address the CARES Act and the impact on plans. However, we have been receiving many questions from all of you and been giving individual responses. We'd like to know if there's more information that you're looking for, and if so, if you could shoot us that question via email, we're going to try to consolidate all those questions and come up with a more formal way to respond to everybody at once, whether that's in writing with another webinar or Q&A. We'll figure that out based on the questions that we get. Thank you all for your time and for returning your forms promptly. Thanking you in advance for that. We are here to help, so please let us know what we can do. And please stay safe.